What's going on, guys? Happy Sunday. Hope you guys have all been enjoying your weekend. What we're going to do is a little technical analysis, a little top-down technical analysis on the Nasdaq 100 here. So a lot of things going on in the market. We've had some high volatility, some very, very big ranges, realistically the past couple of weeks now. Selling started back here. Okay, so this was a big deal here back on July the 11th, and the reason why it was a big deal, market was down 600 points. Not only was it down 600 points, but this is the first day that it lost its short-term demand zone. That short-term demand zone being a 5 SMA. So you can see this, notice this green line. Notice how many days we were kind of power trending over this little green line here, which is a 5-day moving average. Kind of bottomed out here on the 1st. We had about 2 weeks worth of buying here. Now you can see on the 11th, we had a little bit of a blow off top that ran into an upper Bollinger Band here and an immediate reaction selling down 600 points. We consolidated for 3 days before confirming that previous week's lows and then actually closing below the 20-day moving average. And that was very, very significant because we hadn't traded below the 20-day moving average going all the way back to the 5th month of the year. So for over 2.5 months, the Nasdaq 100 was trading over its 20-day moving average. So being a good back test area here, you would have looked for, okay, buyers to step in and start to rally this up, take out the highs and continue the pattern. When that didn't happen and we went into another 4-day distribution cycle, we had yet again another 600 plus point down day. Now, the 24th of July was very, very important for technical analysis because not only are we below its short-term moving averages, the 5, 10, 20-day moving average, long-term investors and institutions and banks, the typical motto is to not really be putting on any long-term positions underneath the 50-day moving average. The bias starts to change, the selling pressure starts to come in until we start to form a floor, and we've had multiple weeks or multiple sessions trading below a 50-day moving average, and now we're starting to curl. Now we're starting to take out previous day's highs. Now we're starting to reclaim some of these daily moving averages. So the bias for day traders, the bias for scalpers needs to kind of remain a little bit more to the sell side as long as we're underneath that 50-day moving average. Now, before you rush to the markets this week and you just start shorting every single pop, you have to be careful because there will be dead cat bounces. There will be green days in a downtrending market. Now, we are not quite 18-20% down. This is technically not a bear market. The market has done absolutely fantastic for the better half of most of this year. 90% of this year has been up, but it's something to start raising concern about. It's something to start putting in the back of your mind. It's something to start trying to be aware of. Okay, so the next major support system that we have is around 17,775. That's the 200-day moving average. Ultimately speaking, in this current cycle that we're in, personally, I would like to see us get down there to that 200-day moving average. That would be a good time to start maybe loading the boat for some longs for that potential bounce. Okay, now that doesn't mean that we don't bounce this week. Again, we're right here at support at the 150-day moving average. You can see we kind of slammed into this 150-day moving average. We wicked off of it. We're holding as support. Any type of gap up that cannot continue after the first 1 to 2 hours of the day, you've got to be looking at Friday's lows. That price is 18,385 as a short position. Between 18,385 all the way down to around 17,900, 950 is going to be a juicy short. So any gap up, any push off the open, not saying that you can't scalp it for a few points here and there, but be cautious, take your foot off the gas, wait to see, do we get rejected, right? Do we get rejected somewhere close to the 18,900 area and start to fall back down? Because when we lose Friday's lows, that's going to be the short position you're going to want to get into. Now, Again, you know, in order for us to say that this is a true bottom, I think we're going to need multiple days where we're holding this area, and we're going to need to start reclaiming some daily averages and taking out some previous day highs. Until we start closing above previous days highs, the bias needs to remain to the short side. That's my top-down analysis. I'm going to be a lot more short-sided bias with the bigger trades that I hold. Anything that I do take to the long side is going to be a very quick scalp. I am going to understand, and I'm going to know that, hey, this is just a little bit of a relief bounce in a down trend. Now, technically, is like I said, we're not in a bear market, so it's not a complete downtrend, but we've been ultimately in a downtrend for the past 3 weeks. Okay, so we've had about a month's worth of selling. That could definitely change now here in August. I would be looking for it to change maybe in the middle to later half of August, where we really start to bounce. But ultimately, I'd like to get down here into this 17,000 price range, 17.7, 17.8, before I start to say that, hey, I'm a little bit more confident that the buyers are going to step in and they're going to actually hold this level. God forbid we lose the 200-day moving average. We could be talking about more serious problems later on down the road. With that being said, I hope you enjoyed this video. Hope you like this type of you know, macro analysis. That way it kind of gives you, starts to paint a little bit of a picture of what you can do to sort of get ready for your day-to-day trading. Because again, 99.99% of the people watching this video now, you're a scalper, you're a day trader, you trade for prop firms. So you kind of want to know, what are you looking for on a day-to-day basis? Right now, my bias is still leaning towards the short side through that Friday's low. I'm not opposed to going long, but when I do go long, my price targets are going to be so tight, you know, 3, 4, 5, 6, 7 points. I just want to get in, get green, wait for the rejection, and then see that reaction off of those supply zones to see, do I have that bigger potential trade coming to the downside? Hit the like button, hit the subscribe button. If you guys are interested in signing up with a prop firm, Apex is perfect. You can get up to 20 accounts with Apex, so you can kind of really spread out your risk. You can kind of, you know, make $1,000 here, make $1,500 here, do that for, you know, time and time again, you know, 2 weeks here, 2 weeks there, 2 weeks there. You'll be very, very surprised how fast and easy you can make, you know, $2,000, $2,500 over the course of a month, 45 days. But if you times that times, let's say 10 accounts, and then you do take out a payout times those 10 accounts, you're ultimately looking at a $10,000 payout, $20,000 payout, depending on how many accounts you have. So the leverage is very, very nice to have with a company like Apex. It is built a little bit more for scalpers because they do have that intraday trailing threshold from your high watermark price. So just kind of keep that in mind. I treat all my Apex accounts as scalps. If I'm looking to zone trade and I'm looking to hold trades for longer and average down and do all that stuff, I'm going to go with another firm. But for my trading style, where I'm looking to get in on my move and I'm looking to be correct, either I'm correct on the move and taking profits, or I'm just wrong and I'm going to close the position altogether, Apex is a firm for you. That link is down in the description box below, and I'll see all of you guys on the next video.